Hello, everyone, and welcome to today's Microstructure Exchange. We have not much in terms of announcements other than the call for papers for the Futures of Financial Information Conference that we sent out in an email. So without further ado, today's very exciting talk is by Tom Ernst, and he'll tell us about the value of off-exchange data. This is Tom's second time with us. So Tom, thanks for coming back.
Thank you very much for having me and for organizing. I'm going to be talking today about the value of off-exchange data. This is joint work with Jonathan Sokobin and Chester Spatt. So I'm going to motivate today's paper with two starting examples. The first one, in terms of a trend, is that exchange data has been growing in value. So if we look, NYSE and NASDAQ, both in their quarterly earnings statements report very strong growth in data revenue. Year after year, they continue to earn more of their money from this data revenue. This has become a very high margin business segment for them. If you look at their expenses in this category against the revenue, it's almost all profit. This is kind of a post-Reg NMS development that when we changed this world where you can route trades anywhere, what exchanges have found is they still have a monopoly on their own data. If you want to know, the low latency feed of what's going on at NASDAQ, you have to go to NASDAQ for that. You can't buy that from anyone else. And here, SIFMA reports there's been an 1,100% increase in data revenue in data fees charged from 2010 to 2018. So trend number one is that exchange data is increasing in value. Now, trend number two is going to be that off-exchange trading volume has been growing. So throughout, for the last 10 years, 30 to 35% of trades have happened off exchange. In the last year with the pandemic, we've seen this grow to even, closer to 40% of all trades being executed off exchange. Part of this was driven by a surge in retail trading during the pandemic. And there's one related issue that kind of ties into this off exchange trading, which is payment for order flow. A lot of this order flow that occurs off exchange is bought directly by market participants where they pay brokers for that order flow. So when we put these two trends together, that the exchange data is growing in value and that there's also more trades happening off exchange and we're seeing more payment for order flow for off exchange trading flow, what we're going to look at today is what's going on with the value of the off exchange data. We're going to look at where this value occurs, what forces make this data valuable or not valuable. So at a very high level, this is going to be the summary of the things I'm going to talk about today. I'm going to talk about three things. The first is that off-exchange trades are reported with a delay. So if you look at when a trade happens off-exchange to when it's actually reported, thousands of microseconds transpire. And that's long enough that this latency becomes an important element of post-trade transparency. So we'll just go over the basic groundwork of the facilities and the latencies involved. The second thing I'm going to show you is that when these trades are finally reported, we see market reactions. We're going to document a flurry of trades and quotes in response to the publication of these off-exchange trades. And it's going to be the SIP publication of trades. That's quite a surprising thing. When we started this project, we would talk to market participants and they would tell us, nobody looks at SIP, it's stale, it's old. We're going to show you there is a very low latency reaction to the SIP publication of these off-exchange trades. And we're going to be able to identify that by exploiting geographic variation in data centers. So we can look at where the signal occurs and where these reactions occur. That exact time will line up with the geographic path. So we'll use geography for identification. And the final thing we'll show you is that these trades appear informed. When we look at the off-exchange trade buy order, the reaction trade is almost always a buy order, or if it's a sell order, it's almost always followed by a sell. And these reaction trades are negative realized spreads, which is consistent with these trades being informed. That if you look at the price they trade at and say the price 5 minutes later, it looks like they're earning money on these trades. And then the third thing I'll cover is the fact that there's kind of a complex information flow here that has to do with this latency. When investors trade, they almost always trade both on exchange and off exchange. They're never going to trade in just one or the other. And that kind of complicates how we might think about things like where is price discovery occurring. What we'll show you is some evidence that off-exchange trades can potentially influence on-exchange trading behavior. So someone can trade off-exchange, and based on what's happening, that can influence how they trade on-exchange. And that can happen before the off-exchange side of that trade is reported. And this captures something of an internal value of data. Not the value of the data as sort of like a data feed that we could sell, but rather the value to the person who knows about that trade before the rest of the market and how they can capture some of that value before it's reported by the SIP. So that's a very high level summary of the talk. I'll take a second to place that in the literature before moving on to point one. And at this point, I'll make one other announcement, which is throughout the talk, if anything's not clear, feel free to interrupt me with questions. Let's have this like a regular seminar. So here, let me just say, there's a lot of different branches of the literature that our paper is going to touch on. The first branch will be exchange data value, of course, because we're looking at the value of the data. We'll also be looking at, dark trading, payment for order flow, the reasons that people trade off exchange. What we're going to really focus on is how, when people trade off exchange, that creates a particular value to that data. And there's going to be some particular low latency strategies around capturing the publication of these off exchange trade reports. So I'll just highlight one paper here. So Aquilana, Budish, O'Neill, recent paper that you probably have all seen. They look at the value of broadly low latency races. We're going to identify one specific low latency race, which is the race to respond to an off exchange trade. We'll look at how we can value that race. Okay, so that's kind of placing in the literature. So now let me start with my first point here. And this is going to be really the foundation for anything that comes after. So if you have any questions, please ask. We're going to look at the trade reporting process, and I'm going to look at the facilities and the embedded latencies involved in reporting an off-exchange trade. So here, off-exchange trade reporting happens in a simple three-step process. Step number one, whenever there's an off-exchange trade between two people, at least one of those people is going to be a FINRA member, and they'll have a reporting obligation. They will have an obligation to report that trade. Pretty simple. They report that trade. Where do they report that trade? They report it at a trade reporting facility. This was named by regulators, you can tell. So the trade reporting facility, takes the trade report. All it does is it takes that trade report from the FINRA member and sends it to the SIP. Now, step three here, this is where the information really reaches market participants. So the securities information processor, that's the SIP here in red, is going to broadcast out that trade report to market participants. Now in the paper, we talk about some of the economic flows here. The SIP sells this data broadcast for about 400 million a year in total revenue. They have almost entirely profit of that. They make about 380 million a year in profit. And some of that profit is passed back to the TRF, who passes it back to the FINRA members. We cover that in the paper. But today, I'm just going to be focused on the information side of things. How long does it take this information to reach the market? When does it reach the market? You can see the latencies for each of these steps. If you're really close to the SIP, you can read the SIP broadcast in as little as 25 microseconds. If you're at one of the distant exchanges from the SIP, it'll take you about 500 microseconds. But by far, the longest stage of this three-stage process is that very first stage. Reporting from the off-exchange member to the trade reporting facility takes over 1,000 microseconds. Now that's fast. If you blink, that's 100,000 microseconds. This is a very fine time horizon, but it's economically meaningful. So to give you just a simple example of low latency trading, suppose Chester buys stock from me off exchange. Maybe Chester is a retail trader, I'm a wholesaler. And I report that trade, I take that trade report, send it off to the TRF. Let's suppose that I also decide I want to go trade on exchange. I go to the New York Stock Exchange, I buy some stock. If I'm already at the exchange, that's going to take me 25 microseconds. Now let's suppose that Jonathan sees my order and decides he wants to buy some stock. His response to my trade could occur in as little as 25 microseconds if he's a low latency trader. That's how long it would take. And then let's do another reaction still. Let's suppose Andre sees Jonathan's order and he decides not just to trade, but to go to a different exchange to do it. He goes from the NYSE over to NASDAQ. That might take about 300 microseconds because you've got to cross the state of New Jersey to get to that other exchange. But as you can see, all of these things are very fast. All of these trades, my trade on the exchange, Jonathan's response, and then Andrew's response at a totally different exchange can all occur before this initial trade between Chester and myself reaches the SIP. So that's a huge difference in the timescales here. Now, for the remainder of the talk, I'm going to analyze two different parts of this diagram. Part 2 of my talk is going to look at the public broadcast of the trade. We're going to look at the market reaction to this off-exchange trade when the SIP finally broadcasts out that trade. I'll show you that there's a sharp trading quote response to the off-exchange trade, and that these trade responses appear informationally driven. That'll be part 2 of the talk. And then part 3, I'll actually go back to the point at which I originally traded with Chester. And I'll show you that there's part of the information flow happening there, where investors who trade off exchange also trade on exchange at the same time. Okay, so with that, let me jump into part 2 here. What we're going to do is we're going to, yeah, Bjorn.
Can I jump in with a question? If you go back to one slide, you referred to technology and geography for the latencies in step 2 and 3. But what is determining the lower and the upper bound that you have put there in green? Is that regulation, or is it technology? Or
it's technology.
incentives?
And what I'll show you in a little bit is that there are 2 different SIPs and there are 2 different trade reporting facilities. So that's going to be determining the upper and lower bounds there. On the original, the longest SIP of all, the requirement is pretty loose, which is that they have to report the trade as soon as practicable. And that one, there's not so much of a tight bound on, when they report it. Even if they send that report off to the TRF as fast as they can, they could always get to the exchange before the SIP broadcasts that trade out. That's what I'd say.
So they may have incentives to not be as low latency as the TRF and the SIP.
So I'd say 2 things. 1, you're right, they don't have incentives. But 2, even if they send the trade off at the exact same time, one goes to the TRF, one goes to the exchange trade is going to always get there faster than the whole processing time to get it out to the SIP broadcast.
Is that geography? Where is the TRF?
That'll be geography. And just the fact that, the TRF to SIP process, that can't happen instantly. So if you send off one trade report to the TRF and one trade report to the exchange, you're not trying to intentionally be slow. Even if you're not trying to intentionally be slow, you'll still make it to the exchange before your off exchange trade is broadcast.
Thanks.
Okay. Andrew?
Yes, Tom. So the trader herself knows that she just traded, right? This 10,000 microsecond is not her problem. So you mentioned wholesalers earlier. Yeah. So given their enormous presence in not only in the wholesale market, but also in the liquidity providing part of the exchanges, they know what happened quite a bit earlier than the SIP information gets in, right? So is that something that you see in the data, or is that affecting your results in any way?
I'll show you as best we can construct the story here. In part 3, I'm going to be showing you the evidence here for me. In this diagram, let's say I'm a wholesaler, Chester's a retail trader. I'll show you evidence that there are trades being placed maybe by the wholesaler well in advance of the SIP trade. I'll show you direct evidence for that. But I'll also talk about there's some issues with the timestamps that make it hard to tell the story in full detail, but part 3 is going to be entirely focused on that question. Okay?
Okay.
Right. Okay. So part 2, we're just going to be talking about the SIP, right? What happens when the SIP broadcasts the trade? So I've done
one thing I would just add, but that's not reflected in the current draft of our paper at this point.
Yes. So this is all new stuff.
The part 3. The part 3.
Yep.
The part 3
is new stuff.
In response to Andre's question.
Yeah. Thank you. Okay. So we're going to start at the SIP broadcast. Here's the SIP. We'll call that time 0. We're going to take all the off-exchange trades, look at their timestamp, SIP timestamp, and call that time 0. And what we're going to do is we're going to say, what happens around the time the SIP broadcasts an off-exchange trade? We're going to look what's happening, right at the time that they've got it. We're going to say what's happening 100 microseconds later, what's happening 200 microseconds after the SIP broadcasts that trade. When we do that, this is the pattern we find. Here's time 0. Right around 200 microseconds, for this, this is a NYSE TRF tape A, we start seeing this huge spike in NYSE quote volume. So you see, very rapidly spikes up. There's suddenly a lot of quotes happening at this exact time interval. And then just as rapidly, it drops off. The spike is there, it's brief, it's sharp, and it's done. And then a little bit after, we see this very big spike at BATS. Activity at BATS spikes up. There's a lot of quotes happening, and then it very quickly drops off. And then finally, we see this spike at NASDAQ. There's this very large spike, all this activity happening at NASDAQ, very quickly spikes, very quickly drops off. And why do we see this sequential pattern? First NYSE, second BATS, and then NASDAQ? Well, it has to do with the geography of markets. So this is a Tape A trade report, and it's going to be coming from northern New Jersey. That's where the SIP is located. So the SIP is located right here in Mahwah, New Jersey. And if it broadcasts out a trade, that signal will first reach NYSE. It'll second reach the CBOE or BATS exchange. And then third, it'll travel all the way to southern New Jersey and reach the NASDAQ. Now, there's actually two different facilities here. So this is, Bjorn's question. He's asking, why is there so much variation in some of these numbers? Part of the reason there's so much variation in that TRF to SIP path is that there are two different trade reporting facilities. One of them is run by the New York Stock Exchange. It's right here in northern New Jersey. The other run is run by NASDAQ. That's located in southern New Jersey. And what's really nice about the fact that there are two different trading reporting facilities is that it gives us a really good chance to make sure we're identifying the reaction to the SIP. So if we go back to this first graph, you might worry, how do we know that it's the SIP broadcast of the off-exchange trade and not something else happening in the market? Whatever you're thinking something else is, that's something else. What we can do is we can modify the path. We can look at trades that had to go down to the NASDAQ TRF and then to the CTA SIP. They'll be still broadcast from the same point, that CTA SIP in northern New Jersey, but that path to the SIP has changed. So that latency is going to separate it out from whatever that something else you're thinking of is. And what do we do when we do that? So now we're going to look at quote responses to trade reports reported through the NASDAQ TRF, and I find the exact same graph. So this is, you can see first there's that spike at NYSE, next there's a spike at BATS, and then there's a spike at NASDAQ. Andrew, go ahead.
Sorry for so many interruptions, Tom, but a quick clarification on the y-axis here. Mm-hmm. It seems that there's 100,000 quote adjustments. Is that per instance, or is that somehow cumulative?
So this is cumulative over our entire sample. What we're doing is we're taking within each security, we're looking, time zero is all the trades for that security. And this is how many trades are happening at exactly that offset. So this is, if you think about this spike here, that's kind of the entire market reaction in the course of a year. Okay.
Okay. Thank
you.
So
it's cumulative. Mm-hmm.
But also you can see that these spikes are pretty big compared to a baseline level.
Yeah. So I'll talk to you about,
and that may be kind of related to your question as well.
Yeah. So that's the other thing I'll talk about, which is when we estimate the total volume here, and I'll give you in a little bit some total volume estimates for these spikes. We'll always subtract off some sort of baseline estimate to make sure we're really just measuring how much trading activity really happens in these responses. And the other thing I'll say about the y-axis is the one way you can tell that this graph is different from the previous one I showed you is that the NASDAQ TRF has a lot more trade volume reported through it. And so the total volume of responses is a lot bigger. So the y-axis has gotten bigger here from the last graph to this one. Okay, so this to us was a really surprising result because when we started this project and we told people we were looking at SIP data, we got a universal response that SIP data is slow, that we shouldn't look at it because, one, SIP is slow, everyone uses prop feeds, and two, it's uninteresting, all the price discovery happens on exchange. So we were pretty surprised about this and we wanted to make sure we had our identification down. So the other thing we can use is the fact that there are two different securities information processors. So this is the other part of Bjorn's question, right? There's a variation in the SIP level. So all tape C securities are going to be reported by a different SIP, the UTP SIP, and it's located in southern New Jersey. So what's nice is that this gives us a new set of geographic pathways. For every off-exchange trade, whether you report to the NYSE TRF or the NASDAQ TRF, if it's a tape C security, that's going to have to go down to the UTP SIP where it's broadcast out, and this reverses the order. Now the signal is going to hit NASDAQ first, CBOE second, and NYSE last. So now if we look at tape C securities, we get the exact reversal of the pattern. First, the spike happens at NASDAQ. Second, the spike happens at BATS. And third, the spike happens at NYSE. The other thing you'll notice about this graph is that the intersect happens much, much closer to zero. And that's because the UTP SIP broadcast trades out much faster than the CTA SIP. They just use a different computer system. They broadcast the trade out faster, and so the reaction happens faster. We can use both TRFs, either the NYSE TRF or the NASDAQ TRF. We get the exact same pattern and order of these spikes. Yeah, Pankaj.
Yeah, so how do some exchanges have speed bumps and they implement it and remove? So how does all that affect the transmission of data? And does
Great
that
question.
slow down or change the location of the spike?
So it does, and I'll show you in just a little bit. Let's table that for now. I'll come back to this, and we'll look at an example of the IEX speed bump. Everything I'm showing you here, these three exchanges don't have a speed bump, but we'll look at a speed bump in just a second. That's a great question. One point I'll make before maybe I jump to that, which is that I've been showing you the patterns in quotes because they're by far the sharpest, but the pattern in trades looks very similar, right? The spikes happen in the same place. We'll go over the magnitudes there of the relative spikes, but they happen in the same place and it's the same pattern. So I'll come back to this, and let me skip to Pankaj's question, which is, what about a speed bump? So one question that we got in our analysis, what motivated this test is someone asked us, could this be some sort of passive response to the MBBO? Maybe what's happening, what we're seeing here with these big spikes is the MBBO is changing, and that's just triggering some sort of, quote or trade updates. So, what we're looking at is off-exchange trade reports. Those will not interact with the MBBO, but just to really finally drive that home, we can use the speed bump of IEX as a nice test of that. So what's cool about the IEX speed bump is that it's differentially applied, right? If you were trying to prevent low latency races and you applied a speed bump to everyone, that would not change the outcome of the race. The race would take a little bit longer, but you get the same winner as before. The way the IEX speed bump really has bite to it is that it only applies to changes in the MBBO. It doesn't apply to changes in the MBBO. So if you want to trade at IEX, you have to go through this speed bump, this 350 microsecond speed bump to actually trade there. But if IEX detects a change in the MBBO and they have an order that's pegged to the MBBO, they can update that without the speed bump. So this offers us a nice test, which is, do things happen with the speed bump? Then we can be sure that those are, new sort of order updates that are coming in response to this off-exchange trade report. And that's exactly what we find. So here's, this one I've actually applied a scale to, but if you look at that IEX bump, it happens one speed bump later in latency. So this is exactly what Pankaj was asking about, which is, the IEX data center, it's pretty close to the SIBO BATS exchange, but the spike doesn't occur there. It actually occurs 350 microseconds later because of that speed bump. Okay. And now there's one last test I want to show you before we talk about the magnitude of these spikes, which is there was a processing time reduction at the CTA. And again, I'm showing you all these spikes because it's very surprising that we found a reaction to SIP data broadcasts. Anyone we've talked to among market participants, when we would say, okay, we're looking at SIP, the first reaction we always get is SIP is stale, SIP is slow, we don't use it. So to really, we really want to make sure that we actually have found the surprising thing that people are responding to the SIP. So we're going to be looking at the CTA SIP. So that's going to handle all the broadcasts of tape A and tape B securities. And what happened was that there were several computational upgrades to the CTA SIP where they used to be very slow about broadcasting out trades. It used to take them about 200 microseconds to broadcast out a trade. So that's what we were seeing here. They'd be very slow about it. And throughout 2020, they actually had a few upgrades where their processing time went from 200 microseconds down to about 30 microseconds. And we see a matching shift in when trade responses occur. So this is looking at these spikes, a few different time periods. In August 2019, the spike at NYSE showed up, a little bit later than 200 microseconds. Around March 2020, it was right here. They had made some upgrades. And then most of their upgrades happened in the fall of 2020. So if you look at the December data, that spike occurs very close to time zero. And so this reflects the fact that the CTA SIP has been broadcasting out these trades faster and faster through time. And we see that shift accordingly. Okay. So at this point, hopefully I've convinced even any skeptics in the audience that we really are identifying the response to the publication of off-exchange trade. We see these rapid, sharp increases in trading and quote volume, and they perfectly match the geographic variation across the two TRFs, the two SIPs, the three exchanges. We can match it across that speed bump at IEX. We can also match it, as there are upgrades at the CTA. So what we've identified here is all the hallmarks of a low latency race. And it's a race to update quotes before trades come in. We call this, trying to avoid being picked off. And it's a race to trade before quotes are updated. You call this sniping stale quotes. So Aquilano, Budish, and O'Neill estimates that across all these different low latency races, they account for about 17% of overall liquidity costs. So we identify one such race, the race to respond to an off-exchange trade report. We could also explain this as sort of back running. So this idea from Yang and Zhu 2019 argues that there's money to be made by trading on public information of past institutional orders. So here, if there's a mid-quote trade that would be reported as an off-exchange trade, people might race to try and take that same position. So now I'm going to actually get into what does the y-axis actually mean. So what I'm going to do is I'm going to estimate the total volume of activity that we're observing in each of these different spikes. And for all of these spikes, I'm going to subtract off, as Chester mentioned, some sort of baseline activity. So I'm going to take the volume in this NASDAQ spike, and then I'm going to subtract off some baseline estimate of what we would maybe see due to chance. And when I do that, the volumes in these spikes are quite sizable. So if you look, around 2% of off-exchange trades actually trigger a response trade in that spike. That amounts to around 650 billion a year in quote updates and about 160 billion per year in trading volume. That happens in that narrow, 20, 30 microsecond wide spike. The other thing, almost all the story can be told in pictures, which is really nice. But we do have some regressions in the paper, and we have a very simple regression that shows that when there's more off-exchange trade volume, that leads to larger spikes, response spikes. So if you think about one of our motivating trends is the fact that more trade is happening off-exchange, it looks like then responding to those off-exchange trades becomes more valuable. The other thing I'll share about these trades before we move on is that these trades appear informationally motivated. If we look at these trades, on average, they earn negative realized spreads. It's about 0.5 basis point of a negative realized spread. So for anyone, if you haven't worked with the realized spreads in a while, what we do is we compare the price you trade at with the mid quote, 30 seconds or 5 minutes later. And the idea is if that's negative, you've made money. The person who placed a buy order sees the price go up. The person who places a sell order sees the price fall. And 60 to 70% of these response trades are the same direction as the trade report. So if you report an off-exchange buy, we're going to see somebody go to the exchange to buy. If you report an off-exchange sell, we see somebody go off-exchange or on-exchange to sell. Then the last thing we can do with these trades before we move on is we can kind of try to categorize them by trade type. Now, all off-exchange trades are reported as just one code, FINRA code D. They don't split out, what's a wholesaler trade, what's a dark pool, what's, a specific dark pool. It's just all lumped together. But we can try and figure out, what's what by looking at whether trades are executing at an even penny price, if they're happening at a mid-quote price, like, 0.5 cent, or if there's some sort of sub-penny improvement, that it's, not a full 0.5 penny improvement, but it's a little bit better than the prevailing quote. And Bamer, Jones, Zhang, and Zhang argued that these sub-penny price improvements are likely going to be retail trades, where by regulation, they have to offer you some improvement, but they don't want to give you a full 0.5 penny spread. So they just give you a little bit of improvement. And what we found, which is kind of surprising, is that there's a similar reaction to each category of trade report. All these different categories seem to be valuable. We see that sub-penny and even penny trades are followed by same sign trade about 70% of the time. Now with mid-quote trades, we actually find that they're often followed by the opposite sign trade. But I think that really says something about the fact that the sign of the mid-quote trade is ambiguous. We can sign these two with Lee and Ready. Lee and Ready still works very well for things that actually happen at the quotes. It works very poorly for things that happen at the mid-quote. So that's really the key difference we found. So here's just an example of the responses. What I'm showing you here is the exchange trading pattern across each of the different trade reports. So the gold line shows you the exchange trading pattern relative to even penny trades. Here in blue, we're showing the exchange pattern around mid-quote trades. And here in red, we're showing the exchange pattern around sub-penny trades. And at least in terms of a reaction to the SIP broadcast, everything looks the same across the three different trade types. Now, it's going to look totally different is when we move over to part 3 of the talk, which is what happens before the SIP broadcast. So this gets back to Andrew's question, which is, if you're a wholesaler, you know about this trade long before the rest of the market does. You could do something in that time frame. And we're going to show you that absolutely investors do. I'll show you some direct evidence that investors trade both on and off exchange. And then I'll show you some suggestive evidence that off-exchange trades can influence on-exchange behavior. And I call this section the complex information flow because what you're doing off-exchange influences what you're doing on-exchange. It becomes kind of hard to use our traditional definitions of where price discovery is happening. We can't just look at where the trade report happens and say, okay, this is where the price discovery happens. Kind of have to look at that whole complete picture. Okay. So here's, part 2 of the talk. We were looking at the SIP pattern of what happens when a trade is reported. So now we're going to be going back in time, back to before the SIP, before the TRF gets reported, back to when the trade off exchange actually happens. The question we're going to ask is, what happens at the time of trade? Is there a bump in activity? And there's a huge bump in activity. So this is the direct evidence that, the people who are trading off exchange are also trading on exchange. And here I've broken it out by trade report. So what we're looking at, let me just remind, because these graphs are a little weird. Each line, I'm plotting exchange activity, and I use the NASDAQ exchange. So we're showing what's happening at NASDAQ. And then time 0 is the time that the off-exchange trade report is actually reported. And it's going to happen anywhere from 1,000 to 5,000 microseconds before is when that trade actually happens itself. And I'll make out one very important point here is that there's an asymmetry between trades and quotes. If you look at the quote responses, there's a lot of quoting activity after the trade publication. There's not so much quoting activity before the trade publication. If you look at trading, the opposite is true. There's a little bit of trading after the off-exchange trade is actually broadcast. There's a lot of trading that happens before the trade is actually broadcast. So what do we make of that? What I would argue is it speaks to an informational motivation rather than an inventory motivation. If you think about trading before the trade report publication, what you're doing is you have information that you've done an off-exchange trade. If you want to take advantage of that information, you could actually go and trade on it. If you wanted to just passively, maybe change your inventory, you might update your quotes. But we don't see as much quoting activity before the trade publication. What we really see is a spike in trading activity. Now, when we look after the trade report publication, the opposite is true. What we see is much more quoting than trading. And that, again, to me, reflects an information story, which is when you see this trade report being published, if you're updating quotes in response, that suggests that you're updating to include new information. You're not just trying to passively change your inventory based on the trade report. Okay, so these graphs are kind of confusing. If there are any questions, I can always come back. But I think I'm going to go through another example that I think will make these graphs a little bit more clear. And this is the question of whether trades take place simultaneously or subsequently. So if you think about simultaneous routing, the idea here is, suppose I want to trade. I'm this gray person. If I want to trade simultaneously, I could route to both an off-exchange facility and an exchange at the exact same time. If I'm trying to, say, trade in a dark pool, this makes a lot of sense. If you're trying to trade and buy a lot of stock, why not always just check and see if there's anything at the dark pool? And at the same time, get whatever is at the top of the book at the exchange. So this would be a simultaneous story. You could also think about a subsequent story. The subsequent story, there would be some first trade. Maybe Chester and I, when I started this talk, I motivated it with, Chester and I making some hypothetical first trade, and then me going to the exchange and doing a second trade. So this is a subsequent message where what's different here is that the very first trade motivates the second trade. You're not sweeping the dark and lit. You're trading in the dark and then going to the lit market to trade based on your knowledge of that dark trade. Yeah, Pankaj.
Yeah, so you're characterizing the market as on exchange and off exchange, but there is also the futures market in Chicago and then the options, right? So maybe there's feedback from those other trades. How do you control for that?
Yeah, that's a great question. So part of the reason we did all those different checks with the SIP is to try and rule that out. And sometimes you actually can see these sorts of spikes for the futures market. So just an example, if you compare trading at NASDAQ with trading at NYSE, what you'll actually see is a spike in trading that happens at NASDAQ exactly 50 microseconds before trading at NYSE. And that's because signals from the futures markets are actually going to arrive from Chicago. They're going to go and they're going to hit NASDAQ just a little bit before. So part of the reason we do all this work to really verify that the spikes we have line up with the geographic latencies is to make sure that we can rule out sign of these spurious spikes. Because if we were just looking at spikes, you're absolutely right. It could be from anything. So part of the reason we do all these different tests with different trade reporting facilities and different SIPs is to make sure that we've got the story right. V, you have your hand up.
Hi, yes, this is V from FINRA's Office of Chief Economist. I just wanted to ask you, on one of your previous slides, you said around 2% of the off-exchange trades trigger the response trade, which is not a lot, to be honest, only 2%. So if you can kind of walk through your intuition of why you expect the off-exchange trades to influence the on-exchange trade behavior.
Yeah.
In a substantial way.
Well, let me actually show you, when we're looking at this graph, this is the 2% in this little spike here. So what that's saying is, here's the SIP broadcast. Time zero is the SIP broadcast of the trade. Okay. So after that SIP broadcast, around 2% of trades get a response. Now, is 2% a lot? That's a really good question. To me, it was actually kind of surprising that there's, anything at all. First, because when we started, our prior was that it should be zero. Everyone told us no one looks at SIP. It's stale information. Nobody uses SIP. So the fact that it's not zero to me is kind of surprising. If you look at the the total trade volumes, 160 billion a year, that's kind of sizable. 650 billion a year in quote responses. So for 2% of trades, it might be something like 5% or 6% of trades are going to get a quote update. And then the other point I'll make out is that most of the value of the data, I think, actually happens before the SIP broadcast. And that's what this graph is really showing, is that before the broadcast actually happens, there's this huge spike in trading on exchange. And I'll show you an example in a bit where we kind of see, sorry, let me just stick to this graph for now, which is when you look at that SIP broadcast, in a sense, it's information that has already been used by the wholesaler. So if I'm a wholesaler, I send my trade report off to the SIP. By the time that SIP broadcasts that trade, I as a wholesaler could have done whatever trades I wanted to do. So the fact that there's still some residual value, informational value, is also to me quite surprising that that value is preserved throughout that whole long chain of reporting. Does that make sense?
Yeah, thank you. One more question, if you don't mind.
Yeah, sure.
How much of these trades are related to limit order versus market order? I'm sorry, I'm not as familiar with.
Yeah, that's a good question. So without getting into what exactly is a marketable limit order versus limit order, the quotes here are going to be the plain vanilla, changes to limit orders. And anytime a trade happens, that's either a market order or a marketable limit order. So that's what I would say, which is the 160 billion, that's trades. The quotes, when I say quotes, that's just changes to limit orders that don't lead to executions.
Okay, thank you.
Yeah. Okay. Pete.
Hi, thank you. Related to this whole point, you've got 160 billion in trades and a half a basis point profit, which I think translates into $8 million a year, which is really tiny. So it seems to me that the right way to interpret this, and maybe it's a variation on what you just said, is that the person who did the trade knows about it before it hits the market. If there's a profitable trade to be done, they go and grab it.
Yes.
But there is a little bit of residual left over because there are fees that you have to pay to execute a trade. So there's some very marginally profitable trades that are left there for others who want to take them, and they may take them for inventory reasons, or maybe they're doing a VWAP order or some, they've got some reason to do a kind of marginally profitable trade. And that's the secondary spike you see after zero. That's my interpretation of what's going on, which I think is not too different from what you said. But
yes, that's one thing I'll point. And then there's one other detail I add, which is part of the value of information depends on what else you know. And so it could be, you could say, okay, there's residual value because, Virtu wasn't able to extract all the value because they had some, trading fees. But could it also be that, I know some set of information. The person who tried to accept the value from this trade had some other set of information. So they extracted all the value they could and sent it to the exchange. But when I see that off-exchange broadcast, maybe I have some other information that allows me to extract still further value from that signal.
Right, but in the picture then allows us to conclude that maybe the information that people are using is pretty common because there is so little of that secondary trading.
Yeah,
I mean, I agree that that's
yeah. Okay, so before I get to Daniel's question in the chat, let me talk about one other thing. So when we talk about the simultaneous versus subsequent routing, one of the things that makes it really tough to evaluate this is the precision of the timestamps. So when we look at these exchange trades, and maybe this is, Pankaj was asking, why am I always focused on the exchange versus off exchange? One reason to really focus on this is exchange trades are always very precisely timestamped. They are timestamped to the microsecond. And, with the latencies, we can actually identify things and say, okay, this is exactly what's happening and when. Off exchange trades are only timestamped to the millisecond. That's not accurate enough to really do this, very careful latency analysis. We're working with regulatory data to try and reconstruct a sort of accurate timestamp where we can look at sort of the median latency, take that median latency and kind of work back out an actual accurate timestamp. I can't show you that today, but what I can show you is my best approximation of that with the public data. So here's going to be, again, starting at our SIP trade of time 0. What I've done on this graph is I'm going to do something where I just take a subset of off-exchange trades that are timestamped 1 to 2 milliseconds before the SIP broadcast. So I'm going to say, okay, I'm going to take all the off-exchange trades that happened in this region along the x-axis and are reported here at time 0. And what I'm going to do is I'm going to say, what is the trading pattern on the exchange around these trades? So if you think about it, if we see trading on the exchange here, that means the exchanges are trading before the off-exchange trade. If we see trading here, that would suggest maybe a simultaneous. People are trading on exchange at the same time that they're trading off exchange. And if we see, I just realized I am trying to show you with my mouse and you can't see it. If we see trading here, this is kind of after, right? So this would be before. This is the simultaneous line. And then this is after. This is where an exchange happens on the exchange after that off exchange trade. So what do we see in terms of the pattern? We see this. Here's the pattern where we're looking at the on exchange across all the different exchanges, what's happening around the timing of these trades that are reported at time 0 and took place 1 to 2 milliseconds before that. And what I'd argue is here, this region, we see trades that are potentially simultaneous. Someone trades on exchange at the same time that they're doing off exchange. So if you do an intermarket sweep and you include some off exchange facilities, that might show up here. If you look here, this seems to me to be evidence for that subsequent pattern, which is, as Andrea asked, do I have direct evidence that people do this? This is the best direct evidence I can get from the public data feeds, which is, there are some off exchange trades that we know took place here right after, but before the trade is actually reported at time 0, we see this spike right here. And this is kind of consistent with a simultaneous, sorry, I get the draw tool here. This is consistent with a subsequent pattern where the off exchange trade is happening here. We see a spike after it, and it's before the trade is actually reported at time 0. And this really, suggests, and this is to Pete's point, right? Like a lot of the data value actually gets used before it's reported, which is the person doing the off exchange trade is able to extract that value and do a profitable trade here. And that trade takes place before the trade is reported. Okay. So that's a lot in one slide. Before I take any questions on that, let me get to Daniel's question in the chat, which is the only way these trades get reported via the SIP, or can you get a direct feed from the TRF? So in theory, the TRF does offer a proprietary feed where you could get the information at a lower latency. So the two TRFs are run by the big exchanges. One is run by NASDAQ and one is run by NYSE. And what we found, let me find this, is that there's basically no uptake in terms of the TRF feeds. So I'm showing here, this is here now time 0 is that TRF timestamp. And we're looking from the TRF timestamp to when the spike occurs. It's about 40 microseconds. If we instead use the SIP timestamp, we see that the spike in trading at NASDAQ happens exactly 20 microseconds after the SIP timestamp. So why those numbers? What's happening here is first you get from the TRF, right? If you go from the NASDAQ TRF to the SIP, and this is tape C, UTB SIP, that's going to take about 25 microseconds. And then if you go from the SIP to NASDAQ, let me do an NAS, NASDAQ, that's going to take another 25 microseconds. So we're sure in our analysis that nobody in this spike is using the TRF feed here, because the spike shows exactly the latency that it would match up with the SIP. It doesn't match up with the latency from the TRF. This was kind of a puzzle to us in terms of why they do it. So part of the answer is, as Pete's pointed out, the total value at stake here is small. Why would they buy this extra feed if the value is small? The other thing we've heard from market participants is that a lot of the cost of using this extra feed is not just in paying for the data, but also integrating it into their trading system. Where, if Virtu or Citadel were to integrate in this TRF feed and it slowed down their on-exchange trading, that would destroy any potential profits. So part of the value here is that, part of the cost is just the data feed subscription, but then part of it is integrating it into your trading system. So there is a separate TRF feed, but nobody subscribes. Okay, so with that, let me conclude and then open it up to the general questions here. So the first thing is that off-exchange trades are reported with a big delay. Thousands of microseconds after the trade happens, it's actually broadcast out by the SIP, and that's an economically meaningful delay. The second thing we find is that these off-exchange trades do cause market reactions. So when people came to us with the prior that, off-exchange trades are not so important in terms of the informational value, we know that's not true. Just from this SIP broadcast, we see that there's a flurry of trades and quotes in response to the publication. And when we look at this geographic variation, we can be sure people are responding to that SIP broadcast. And the trades do appear informed. Buys following buys, sells following buy sells, and on average, negative realized spreads. But we think that actually most of the exchange value is captured before that. And that gets into this point about there being a really complex information flow here, where you can have an off-exchange trade that can motivate an on-exchange trade long before the off-exchange trade is actually reported. So as part of this, we see trades before publication and quotes after, which kind of reflects the idea that these trades really are informationally motivated. We see evidence that there's some subsequent trade behavior, not just this, you're not just sweeping the dark and lit, but actually your dark informed trades are influencing how you trade on exchange. That some of the value of this data is the fact that you can use this off-exchange knowledge before it's public to change how you trade on exchange. Okay, and with that, I'll stop and open for general questions.
Thank you very much, Tom. Those of you who may have questions, please use the raise hand button as usual, and we'll call on you. Tom, while we're waiting for hands to come up, a very quick question from me. So you mentioned realized spreads, and I think you said you're measuring them with 30-second intervals.
Yeah.
And then I think you said that they're negative, so it suggests that whoever is still left there to provide liquidity might be losing. Have you looked at shorter horizon spreads? Because if you're a modern liquidity provider, 30 seconds is probably a bit too long for you. Are they always? Is there a quick price adjustment basically, or is there a way to get out?
So I've looked at 1 second spreads and they're similar. I haven't done finer than that because even 1 second is pretty coarse. So do you think like maybe a 500 milliseconds, or what do you think?
I would say that 1 second is pretty decent.
Okay.
But yeah, the longer we wait, the more negative they become usually.
Yeah.
So yeah, but if 1 second gives the same result, I guess that's pretty good for me.
Okay. Sure.
And if you don't mind, one more question. So I would imagine that if these were super lucrative opportunities, then Citadel and Virtue would have changed their quotes and then would have gone and picked up everybody else's. So
Yeah,
I'm guessing what you see is mainly for not the largest, I don't know what you call them, arbitrageable trades, right? These are relatively small that Citadel and Virtue don't really care to pick off.
So we're working on looking at that with the regulatory data. What I can say from the public data is that these people are sophisticated enough to trade in microsecond time. So that is, it's not a small time operation at that point, right? Like if they're trading at the microsecond level, they're pretty sophisticated. The other thing is it could always be Citadel responding to Virtue or vice versa. And I will say that, some sophisticated market participants did tell us that, part of the issue is, even if they are making some money here, it might not be worth it for a large player to risk changing their trading system to incorporate this. Chester, did you want to add to that?
Well, I was gonna, no, I was on more of a prior point about the NYSE and the prop, and when they started to include the data in their prop feed, but.
Okay. Oh, I can show you that graph, which is there was no uptake. So when NYSE, so this is kind of the other weird part of this story, which is that these data feeds are actually sold by the exchanges themselves, which you might think, the exchanges are in the business of selling data, but this is, the TRF data is, coming kind of from off exchange. You might think of off exchange trades as competitors to the exchange. So it's kind of like a competitor in that sense is the one responsible for selling the data. And when so here's an example of where the NYSE started including these off-exchange trade reports in their slow prop feeds. They do not include these TRF reports in their fast prop feeds that they market to the high-frequency traders. And there seems to have been no uptake. That basically the reactions still seem to be to the SIP. Oh,
Bjorn?
Yeah, thanks, Tom. It's a very interesting paper, and I also liked Pete's interpretation of the results. That these are maybe low value trades that are picked up by Revox and others. But along the lines that what you were just saying, I think it looks like a very sophisticated response in that these spikes are so sharp that we're at the cutting edge technology because they react in almost the same microsecond, and that doesn't sound like an execution algorithm to me. That if I'm not outdated here, then I don't think they operate at the cutting edge latency. So it seems like a HFT response.
Yes, that's how I would say yes. It's, you could describe these people as HFTs because they are responding in low latency environment. The other thing I'll point out that's kind of interesting is we see sometimes like a response to the response. So this, I've only focused on that first response. So this is, here's time zero. This is the SIP publication of the off exchange trade. We see a big spike at NASDAQ. There's also this kind of secondary response. And what this is the response to that response. So the SIP report comes out, it causes a bunch of trading on NASDAQ. Then you see some other HFT firms actually trade in this window. So this is again, a 25 microsecond window, and that's going to be HFT, like fastest latency, fastest of the fastest. They actually trade in response to that trade, which is kind of cool. So again, I think evidence that there's, some sophistication going on here. Yeah, Pankaj.
I have two questions. So first is on the SIPs investment side, right? So there was talk about improving that, or is it because of the regulatory? They give 1 second to report, and that's why everybody is delaying. Is it intentional, or is the infrastructure not ready? So that's the one.
So I think there's two parts of it. There could always be intentional delays, but what I would argue is, let's go back to this picture. Even if you really try to shorten these latencies as much as, if you were a regulator and you said, okay, we've got to really bring these latencies down, it's hard to shorten them more than what they're at, which is you're never going to be able to get to zero. Things just take time. So if, let's say that the NYSE TRF is located in northern New Jersey and you broadcast that signal out to NASDAQ, there's no way to eliminate that latency. It just is a feature of the geography of the market. And the fact that that latency exists means, if you start, if we think about a race here, let me get the annotate tool back. If you think about a race where I'm a wholesaler and I am trying my absolute best to report this trade as fast as I can, it's still going to take more than 0 time for it to go to the trade reporting facility and then to the SIP. I'll also say, I don't have any motivation to try and report it as fast as I can, but even if I do, it takes more than 0 time. And so my order to the exchange will always get there first. So I think even if regulators try to bring these latencies down, they're never going to be able to bring them down to 0. And there's always going to be the fact that I'll have a latency advantage in trading the exchange before anyone else.
Okay. And I have.
So then, if I can just add on the point about this, that there's a basic latency. In some respects, arguably, our regulatory system doesn't really directly reflect that. The nature of NMS and the nature of NBBO and a lot of these terms, they almost seem to exist in an implicit environment in which latency was 0. But if you think about like NBBO and the NMS, the requirement in NMS with respect to trade through, what those things then mean in a world where there is latency, I think is an important issue for regulators to come to grips with.
Right. That's correct. And I have a related follow-on question. So you didn't talk much about size of the trade, right? So there may be institutional traders who are doing like large portfolio shifts, and that's what will move the prices and everybody will get worked up. But you may be giving equal weights to a small, tiny trade and a large trade. So at least in the regressions and
that's a good point. I will say I should think about splitting trades out by size. The one thing that I have done that maybe gets in that direction is if we split them out by even penny, mid quote, and sub penny, that's going to also kind of be splitting by size. And we see the same pattern across all these 3. But I should maybe redo this with the explicit quote, explicit split by size. That's a good suggestion. Thanks.
Okay.
Pete?
Yes, sorry, go ahead.
Back to Bjorn's comment on my comment. If we accept the hypothesis that these are high frequency traders doing these trades with this short time lag, and then ask the question, why would a high frequency trader want to do a trade that a competitive high frequency trader turned down because the person behind the trade initially could have done it? I think the answer probably is not that the high frequency traders are using different information, because they're mostly using the same information. It's just kind of ticker information about what trades are occurring. I think the difference probably is they have different inventories. So some of them are long, some of them are short, and some of them want to cover and some of them don't. And so they cover on the trades where they were short, but the originator of it was long and he didn't want to cover.
Yeah.
Something like that.
That's possible. I think Fatima has a paper that maybe covers the inventory story nicely for the European data. I think the one thing that makes me struggle with the inventory here is that it really lines up with the SIP broadcast, right? Where they know what their inventories are. If you're an HFT firm, you know what your inventory is. You didn't learn anything about your inventory here. You learned something about someone else's inventory. And that, to me, I would call that information. Inventory and information stories, they can always bleed together a little bit. But if you're learning, about something someone else is doing, that to me suggests that it's an informational motivation, not an inventory one.
But you have a shadow price kind of attached to the asset that represents its value to you.
Yes.
So when you get some other information about somebody else's inventory, you adjust your shadow price a little bit, but your shadow price is different from the other guys because your inventory is different from his. That's what I'm saying.
Oh, okay. Yeah. So that's a good point. Yes, that it could be your inventory, not just your own information. Yeah. That's a good point. Avi?
Yes, I was just gonna say if there's any way to link this to profit in any sense, because for these sophisticated trading, it kind of takes substantial investment in technology and all of that. But just an idea.
Yeah, that's a good question. So in terms of, if I'm doing my math right here, if we look at this is, only a couple million a year. Depending on whether, these quote updates are avoiding being picked off, that can actually be quite a few million more in terms of just using the realized spread as a profit measure. In terms of what it costs the exchanges to actually use this trading fee and set up these high frequency trading links, that I'm afraid I don't have any information on. That's all private information. Even sometimes the price lists from the exchanges are not public in terms of what they charge for these fees. So I can talk about the revenue, but you're right. I can't really say what the profit is. I don't know enough about the costs. Yeah, thanks. I see there's one question in the chat. Hans Heidel suggests, that I might want to suggest the number of trades rather than the time for realized spreads. So I don't know, Hans, if you're here, could you explain a little bit more what you mean by that? Otherwise, I'll follow up via email.
Yeah, it's just basically event time or trade time rather than calendar time. So you can, rather than going out a second, you did 30 seconds, you did a second. You can say, let's say 5 trades, 10 trades.
Ah, okay, gotcha. Got it. Yeah, okay, that's a good suggestion.
My guess would be that Hans is on his cell phone, given that
Yes.
Government organizations do not allow Zoom. Mm-hmm. Thank you for joining us, Hans, even despite the technological trouble. Mm-hmm. Folks, if there are no questions, I think we have, oh, no, that's not a question. I think we've had a lovely discussion. And Thomas and Chester, thank you so much for joining us and sharing your results, including the new results. And
Pete,
thank
do you have
all.
A question?
Oh, that's just applause. He's applauding us.
Oh, sorry.
Thank you, Pete.
Sorry about that.
So thank you all for coming. And we will see you in 2 weeks for the next one.
Thank you very much, Andrew.
Thank you.